Good morning. Today we're going to talk about commercial umbrellas as well as Excess 101. My name is Carly Rom. I am the underwriting representative for Griffin Underwriting. Quick little review of the agenda. We'll go over a brief history about Griffin Underwriting. I'll talk about our products, some vocabulary, policy provisions, opportunities to talk to your insureds about this particular product, common exposures, coverage details, writing any type of business with Griffin Underwriting, and then as with every tutorial, I like to give a contact list should you have any questions or need further assistance at a later time. So Griffin Underwriting was founded in 1928. We still are family owned and operated by the Griffin family. We were one of the first surplus lines brokers in our region to be granted binding authority by Lloyd's of London. We have just over 31 underwriters and brokers in 3 offices in the Pacific Northwest. We offer solutions for personal lines, commercial lines, transportation, as well as brokerage. We do have a single sign-on and 100% automated binding with selected classes on our online presence. So when we're talking about umbrella and excess, basically these types of policies are designed to indemnify the catastrophic claim. The forms are specific to each carrier. And then when we're talking about excess policy, it provides the additional limits of liability over the underlying policy. It's only applicable once the payments are made under the primary and those are exhausted. And these ones are follow form. They do not offer drop-down coverage. When we're talking about an umbrella policy, this increases the liability limits. So the coverage goes over the exhausted or reduced aggregate limits of the underlying policy. It is written on the occurrence basis, but it can be endorsed to work with a claims-made underlying policy, such as a professional liability policy. This is drop-down coverage, or it does have that potential, and we can write these on a standalone basis. So when we're talking about follow forms versus standalone, follow forms are typically drop down, then they're standalone. We've got underlining policies, there's schedule and maintenance, self-insured retention, earned premium and fees. So there's 2 of them, there's the 25 minimum earned except for short-term policies, and then fully earned policy fees. So follow form versus standalone. When we're talking about a follow form, this attaches to the insuring agreement, their terms, as well as their exclusions and conditions of the underlying policy. For standalone, there's no reliance on the underlying policy terms or conditions. It's standing alone. This is known as the true umbrella. It covers gaps in the primary coverage. When we're talking about drop-down coverage, it's not covered by the underlying policy, but not expressly excluded in the umbrella policy, so coverage would then drop down, if you will. It is subject to the umbrella's terms and conditions. It also has a subject of self-insured retention, or the SIR. When we're talking about underlining policies, this provides the first dollar coverage over which the excess or umbrella policy extends to the coverage. Schedule of underlining, this lists all the applicable policies that the excess or umbrella policy is providing coverage over. This is part of the declaration page, so those underlining policies will be listed on the umbrella's deck page. Maintenance of underlining, basically for these types of policies, there is a condition that requires the insured that all underlining policies be kept active with the same coverage as represented at the time of the excess or umbrella policy inception. Essentially what this is telling you is in order to have an umbrella maintained, you have to have that underlining policy in good standing. When we're talking about self-insured retention, or SIR, this is the amount of money the insured would be responsible for the event of a drop-down coverage. So it only applies to claims covered by the umbrella and not covered by the underlying policy. This is often confused with a deductible. SIR losses usually don't need to be brought to the insured's attention. A deductible does not negate the duty to report a loss, however. Also, the SIR has no effect on available policy limits, whereas a deductible may reduce the policy limit. I put up this little chart because I myself am a visual learner, so this helped me. Basically, it shows the differences or compares an umbrella versus excess. So does it increase the limits for both the umbrella and excess? Yes, it does. Does it have drop-down potential? For the umbrella, it does, not typically with an excess policy. Does it offer broader coverage? Yes, with the umbrella it can, not typically with an excess. Is there an insuring agreement, exclusions, and conditions? The umbrella has its own set of insuring agreements, exclusions, and conditions, whereas the excess is a follow form, so it's going to follow the underlying policy. Self-insured retention, maybe with an umbrella, not typically with an excess. Underlining coverage requirements, do those underlining policies have to be in good standing? Yes to both the umbrella and excess. And is there a policy deductible? No, for either the umbrella or excess. When we're talking about policy provisions, most often the provisions include the insuring agreement, defense and settlement, limits of insurance, who is the insured, exclusions, as well as common conditions. The insuring agreement, this is either coverage A or coverage B. For coverage A, it's excess liability insurance, and it is a follow form. It provides exceptions to the underlying carrier insuring agreement. Whereas coverage B, the umbrella liability insurance, it provides the details needed to determine if coverage will drop down or not. When we're talking about defense and settlement, the underlying policy pays defense costs until limits are paid as a judgment or in final settlement is laid out. These can be inside or outside the limits depending on how the policy is written. The umbrella carrier may elect to join in with the defense, and the limits can be inside or outside the umbrella limit. As far as the excess policy, the defense will follow the primary form. Some common exclusions. Some may not apply to every single policy. The federal state employers' liability, workers' compensation, and unemployment or similar laws. Pollution, or pollutants rather, silica, asbestos, and lead are some examples. Intentional acts, uninsured, underinsured motorist coverage, punitive damages, and then war and terrorism. These are some common exclusions on these types of policies. So when you're talking to your insureds about writing either an umbrella or an excess, don't be afraid to use just plain old statistics. So nearly 10% of a corporate liability loss exhausts the primary layer. The average auto liability jury awarded has increased 27% per year since 2006, I believe. The number of personal injury claims that has been filed has increased 26%. The average premises GL jury awarded increased by 10.5% per year, again since 2006. The average GL claim can take 7 years to go through, including investigation, discovery, trial, and jury decisions. With awards increasing 10.5% per year and the settlement taking up to 7 years to finalize, an initial claim of $750,000 could net over $1.3 million once the claim has closed. And only 41% of small businesses have an umbrella. If you've taken any of the other tutorials that I've offered, you'll note that I've made comments about a lot of insureds who have small to medium-sized businesses. One claim can make it to where they have to close their business if they don't have adequate insurance or adequate coverage. Some common exposures, limitations on the primary insurance. So when we're talking about the policy limits, insufficient for the maximum possible loss. Basically, what that is saying is, although your insured may have an underlying policy, they may not have high enough limits. This is a great opportunity for them to make sure that they have adequate coverage. When we're talking about territory, these can extend outside the U.S., Puerto Rico, or Canada. This also can expand who is the insured and increase the definition or alter the definition of the insured. As far as exclusions, it has contractually obligated liability. When we're talking about emerging issues, basically what this does is it helps to protect the insured against the unknown. Future value and present upcoming claims can be addressed with this. And then what's the next big litigation issue? This is just an example of how to open up conversations with your insured to talk to them about the need for excess or umbrella coverage. Potential damages, talk to them about investigation and testing costs. Containment and remediation expenses, if there's a fire, say in a small restaurant and they have a sprinkler system or the fire department comes and obviously puts out the fire, a lot of that remediation expense is due to water. That's very, very expensive. Bodily injury and property damage, loss of earnings, and then emotional distress. It is stressful to file a claim. Some potential defendants, obviously the property owners and managers, retailers, growers, manufacturers and distributors, and then insurance agents. This is just an example of who to talk to, what type of insured you want to have these conversations with. So when we're talking about coverage details, general liability, auto liability, employer's liability, we can write umbrellas for all those types of policies. We do have a capacity of limits of up to 20 million. The excess umbrella is available for another 20 million. We offer single limit per occurrence as well as an aggregate. Underlining exposures can be scheduled or written as a blanket. Short-term policies are also available. What this does is it helps to fulfill the contract requirements midterm on a general liability policy, and then we would write them as an annual policy at the time of renewal. And then minimum premiums, depending on the underlining policy. For miscellaneous general liability or contractors, we can write a minimum premium as low as $500. Public auto and trucking as low as $750. And then manufacturers and products as low as $1,000 for that minimum premium. Again, it's very dependent on the underlining policies. So in order to get a quote for this particular type of policy, we would need the Accords 125, the 126, and the 131. You can find these applications on our website, gogus.com. You'll need to have everything completed. If you need to know how to fill out an application, there is a tutorial on how to fill out court applications. The underwriter or carrier may request additional information, but let's start with the applications. Once you have them filled out, you can scan them in and email them to submissions@gogus.com. Your policy will be entered into our system, assigned a submission number, and then the forms will be given to an underwriter to work on your quote. If you have any questions or need help in any time, please don't hesitate to reach out to us. If you're an Allstate agent, please email csr@gogus.com, or you can call us at 844-859-1766. If you're an independent or non-Allstate agent, info@gogus.com, and you can call us at 800-562-8095. Again, my name is Carly Rom. I'm the marketing representative. I'm happy to help in any way I can, so just feel free to reach out to me. We want to thank you so much for working with us. We look forward to doing more business with you in the future. Have a wonderful day.